Hi there, Etoro. It is Monday the 9th of January, and I'm going to be taking a look at what's happened through some of December and the last week. Let's take a look. Apologies for the lack of video content for the past few weeks. I've been traveling through South Africa, seeing my close family, some of whom I haven't seen for many years. And South Africa has this problem with energy. There have been rolling blackouts in some locations for up to half of the day, which obviously makes it a little tricky, but I'm back in London now, and so the regular videos will resume. I wanted to start by taking a quick look at December. December was an awful month through last year, and I think a lot of people were worried that it was going to be similar to 2018, and it ended up rhyming at least with December of that year, which was a very, very bad year for the stock market in general. You can see on screen that the Nasdaq 100 lost just over 9% during that month. And in the top right hand corner, you can see that the S&P 500 lost nearly 6% for December. So not a great month overall. My portfolio also lost roughly 9% for the month. Now, there are quite a few peculiar reasons for December being a bad month, and I'll talk through a few of those as a part of this video. But for now, if we take a look at Chinese equities, we can see that for December, I haven't marked it on the chart as clearly as the others, but for December, the Chinese market didn't have nearly as bad a month as the US and I think European markets did. And in the bottom right hand corner, I've highlighted the US dollar just because the rise of the US dollar through last year became quite a big problem for asset prices around the world, especially if you were outside of the US, and a lot of that strength has come out. And the dollar is now retesting the recent lows that we've seen in the past 2 weeks or so. If the dollar does continue to drop from here, it will be very good for equities as well as non-US countries for a number of reasons that I outlined through last year. Now, why was December such a bad month for equities? Now, there are a few reasons, but one of those reasons will be tax loss harvesting. Now, tax loss harvesting is a common concept, and it's used in many countries around the world. Effectively, it means that you can lock in your losses for 1 year, carry those losses over to another tax year, and offset them against any gains that you might make in that year. Now, in the US and other geographies, for example, the UK, there are rules around the timing of selling and rebuying particular equities. The rule usually goes something along the lines of, if you have sold a particular stock, you need to wait a period of time, let's say a month, I think in the US it's 31 days, for example, before you rebuy that stock. And that's aimed at preventing you from selling, getting the benefit of the tax loss harvesting from that particular stock, and then rebuying it immediately. So within the US, the tax loss harvesting tends to happen towards the end of the year, the calendar year. And because there would have been a lot of people carrying losses through last year, there would have been a good deal of tax loss harvesting towards the end of the year, so through December. This definitely isn't the only reason that the market sold off through December. So I've got a time-based search here just on news articles so that you can see what the sentiment was through December, at least as far as the mass media is concerned. And you can see that there were lots of articles about how hawkish the Fed was being. And the Fed was being particularly hawkish in their messaging. There'd been a lot of relatively good news out of the US in terms of macroeconomic data through November. So inflation was coming down, jobs data was going in the right direction, etc. And the Fed was putting out messaging that was aimed at taming any rallies in the market. So this messaging, I think, did some of its job. I think that some of the drop in December was because of this messaging, despite the fact that key macroeconomic data points were improving through November and December. And then another reason for the drop in equities through December is that even though we had the macro picture improving with regards to inflation, the Fed getting more or less what it wanted, inflation coming down, growth slowing, it also means that the growth within the US economy would be slowing down. And so we saw a resurgence in those questions about what is going to happen to the US economy through 2023. Is there going to be a recession? If there is a recession, how long is it going to be? How deep is it going to go? And the market was definitely focused on those questions and quite negative about the outlook when it comes to the United States GDP growth. However, now we're in January. Suddenly the month flipped from December to January, and the sentiment in the stock market has shifted. It's done a 180-degree turn very, very suddenly. And this tends to be the case. It's a very strange thing for human beings. We tend to treat the ends of months, the ends of quarters, and the ends of years very specially, not just in the stock market, but in our lives in general. I mean, just think about the New Year's resolution. The fact that we've shifted into a new year means that people want to change their personalities. There are lots of people that change jobs in January too. And so for those of you that have been investing for a while, you'll know that the shift from December to January can be quite large in terms of sentiment and its effect on the stock market. So much so that there is something coined called the January effect. So this is the hypothesis that there is a seasonal anomaly in the financial markets where security prices increase in the month of January more than any other month. And there are a few theories about why this is so. One of those theories is because of all that tax loss harvesting that happened in the last year, and people are now able to rebuy equities that they wanted now that they've locked in those capital losses that they can carry over. Also, people are paid their bonuses in general towards the end of the year, so now they have more money to spend when it comes to January in terms of investments. But it's important to note that the January effect, although sometimes it is very strong in certain years, it doesn't always happen. Another reason for the strong performance in equities through January is that the weather in Europe has been strangely warm. There was a very cold spell in December for about a week or so, but now the weather in London, for example, it's been 10 degrees or higher for the past 2 weeks, which is completely unusual. And this means that people are not using as much energy to warm their homes at the moment. Now, one of the strongest components in inflation in many countries within Europe was that cost and anticipated cost and energy prices. So if people aren't using as much energy as had been anticipated, that means that current and near-term future demand for energy is likely to go down, particularly since we are now approaching spring when it becomes warmer. And this crushes that component of inflation. So if there's less demand for a thing, the prices for that thing then drop, and inflation is the increased price of an asset or a service. And so many people are now anticipating that energy inflation is going to drop off incredibly sharply following the prices of things like natural gas. And so on screen I have the price of EU natural gas. You can see that it reached a crazy high in August, but you can also see that since the beginning of December, the price has dropped. It's been cut in half. Now, it will take a while for the drop in these prices to make their way through to the consumer and businesses, but it will happen later in the year. This is great news. It's incredibly lucky, except that maybe it's been driven by global warming, which, is not great either. But for now, in the short term, it's very good for people and businesses because it's showing us that inflation in this particular area is probably going to drop quite sharply very soon. The other thing that's increased optimism in the market for January so far is the jobs data that came out last week. So there was a combination of bad news and good news in the data that we received. Everyone knows by now that the Fed is looking at the levels of employment or unemployment in order to determine what it should do in the near-term future with regards to interest rates. Now, analysts had been expecting that the December number for jobs would come in at 200,000, but instead it came in more than 10% higher than that. And you would expect that the market would be quite unhappy about this. At the same time, we also got data that showed that wage growth in December had slowed significantly. Now, wage growth or wage inflation tends to be one of the stickier types of inflation, and the fact that it slowed down so much, as you can see here, ignited a stock market rally as investors bet that the Fed would not need to be as aggressive with its policy tightening in the end. So whilst these data points seem to contradict each other, the jobs number came in higher than expected. The jobs number is still trending downwards. If you look at the trend line, I don't have it up at the moment, but it is trending downwards. And at the same time, we can see that wage growth is slowing significantly, so the Fed's policies are taking effect. One of the other key items that are driving optimism in the market at the moment is that inflation in a number of European economies is coming in a lot lower than expected. And this is setting the expectation that inflation in those particular markets, and they're important markets, Germany, France, and I think Spain is another one. There might be more, but those are the ones that I have been focused on. And if inflation has topped out in those geographies, this is definitely good news for the EU as a whole. And the last item that I wanted to talk about that's driving optimism in the markets is the fact that China has been removing more and more of its restrictions around its zero COVID policy, Because China is such a large component of the world economy, it has the power to pull up the entire world economy if it starts firing on all engines once again. There are lots of aspects to China reopening that I'd love to touch on, but I need a much longer video to talk about those. For example, the price of certain commodities such as oil, copper, iron ore are likely to go up if economic activity in China gets back to normal levels. If the prices of those commodities go up, that means that inflation in other places in the world is going to remain under pressure. So it's something to keep an eye on, but for now, there are lots of companies in China that are very, very cheap. They're trading at an enormous discount. And this combined with the fact that US auditors of Chinese companies that are listed on US stock exchanges have basically green-lighted those companies, I think that the Chinese economy could have a booming year through this year. All right, so what about this week? Well, we're entering earnings season once again, and this week is going to be a very interesting week. Lots of the banks in the US will be reporting earnings through this week. We also have TSMC that will be reporting. They're a bellwether for the semiconductor industry, and if anyone has been watching SMH, that's an ETF that tracks semiconductors, you'll know that it had a terrible year, even worse than the NASDAQ 100 through last year. So I'll be following TSM and many others quite closely to see if there are any opportunities for this year. And in terms of the macro things happening through this week, well, there aren't a hell of a lot of data points, but they are very, very important data points. So we'll be hearing from Jerome Powell tomorrow at about 2 o'clock. But even more importantly will be these inflation numbers out of the US. On Thursday, the initial jobless claims numbers out of the US. And I'll be watching the GDP numbers out of the UK very closely on Friday. I would like to do something a bit more portfolio specific in my video next week. I'd like to talk about portfolio construction. I've had a lot of questions around portfolio strategy, and I think portfolio construction is one of the key elements of portfolio strategy, so I'd like to answer those questions in my video next week. All right, that's it for this week. Have a good week. Goodbye.